It was such a great move and I got stopped out. I was completely devastated by being stopped out after this FOMC move, guys. The FOMC completely destroyed me, but not the FOMC itself, but the trades I was taking after that. So all of those statements were thrown to me by students of mine that have been trading around the FOMC statement. One of the worst times to place trades is straight after the FOMC, but I don't mean like minutes after the FOMC announcement, but literally on the next day. The reason why this happens is not very obvious. Most traders, be it swing traders or day traders, wrongly assume that after an overextended move in either direction, they have higher chances of scoring big if they place a reversal trade or a trend continuation trade. So unfortunately, this type of trading does not carry much success, and most of those trades end up being either flat trades or losing trades. And since trading is a game of chance and stacking the odds in your favor will actually decide who is the winner in the end of the show, I would like to explore further the details regarding why this type of trading will bring you to flat or losing trades in more details. So stick with me, guys. In the next part, I will show you why this happens. Traders call it consolidation after expansion, which is a key market principle. A variety of independent backtests and professional trader studies say that FOMC days, especially with major surprises, guys, tend to have large directional moves, but the day after the FOMC often has reduced volatility, smaller ranges, and lower average true range. So if, let's say, on your day one, which is the FOMC day, you have a large bullish move, this will be considered as, let's divide this into day one, day two, and day three. And you see in a while why I'm also including day three as well. So this will be day one, here is day two, and this third section is day three. So if during day one you have a very large bullish move, during day two what happens is the move kind of slows down and it range trades. It may give you a false breakout and go lower. Day three though is something that's not a lot of traders have thought about and spoken about. So the typical FOMC day SPY range is close to 2%, which is kind of the average range, and the day after it's close to 0.7, which is almost 4 times less. In other words, this is a range trading day. This is exactly what this image displays. And as they say, the big money already has made a move, and now the market needs to breathe. This is the type of breathing that the market does, and during this breathing the market is digesting new information, which are policy changes, rare forecasts, etc. It's also repositioning or profit taking occurs, which causes this consolidation. The third reason is that traders are simply hesitant to take new positions until there is a clear direction post the volatility of the FOMC day. So usually what happens during those consolidation phases or day two after the FOMC announcement, you can see a lot of inside bars on the daily time frames, dodges, low volume compared to the FOMC days I just mentioned, and wicks on both sides due to indecision. The FOMC day is the move, and day one is the pause, day two is the clue, guys. Just keep to those 3 very simple principles. So if your first day you have the FOMC day, this is when usually big players are reacting to the news. This happens here in day one, and you have the directional move. This could be either up or down, and the move is usually very sharp. So what we usually do in my day trading program, we don't trade the day of the FOMC announcements unless we are already in a trade which exhibits, very bullish or bearish behavior. We are deep in profits, and there is not much that we are risking at this point. We don't particularly trade before the FOMC announcement. This is literally the same as gambling. Sometimes I can place trades 10 to 15 minutes after the announcement, but on the same day, on day one. I don't usually or try to avoid placing trades on day two. Those trades tend to be a very flat days or losing days. So if you're placing trades, they need to take this into consideration, and your target should be a lot more conservative. So definitely not the ideal environment for hitting double-digit returning trades. And this day 2 is when everyone is on the sidelines, and this is when institutions are digesting the macro changes, retail overtrades are choppy ranges, and there is literally a low conviction, so there is lots of fake outs. The best thing to do here is to basically buy the support and sell the resistance, but this is the second best. The really best thing is to do nothing and to monitor what the market will bring you next day, because what's the point of being stopped out or taking a 1-to-1 or 1-to-2 risk to reward ratio trade when we've simply seen in previous videos that this is not a trading edge. We need to be aiming for double-digit returning trades. So day 3, this is when the interesting part begins and the shift changes. So the market has already absorbed the news during the first 2 days, and traders have adjusted their models and expectations. So the volume is slowly but surely returning, and then the trend either resumes, so we're gonna see a sharp bullish continuation, or we're gonna see a bearish reversal, guys. Either way, we're gonna see some more volatility and smart money again chasing one or the other way of the trend. So what do smart traders do around the FOMC days, guys? So the first thing is, if you're already in a trade, you can try to squeeze the maximum profit on day 1. If you're not, try to stay away any trades during this day unless you're very experienced and you know what you're doing, and you can potentially place a trade 10 to 15 minutes after the FOMC announcement on the same day though. The next day, which is day 2, smart money simply stays outside of the market. They're digesting the information, seeing where and which way the markets can potentially either resume the trends or reverse the trend. And on day 3, which is the second day after the FOMC announcement, this is where the real move continues or begins. If there is a trend reversal, then we're gonna see a new trend developing. If there is a trend continuation, maybe the news from the FOMC day were very strong and they're in support of the overall trend direction. And to wrap up, guys, the FOMC day 1 is where the real move begins. FOMC day 2 or past the FOMC announcement is where the pause happens and the shift starts to enroll. And FOMC day 3 is where you should be considering taking either a reversal or a continuation trade. So smart money does not trade on day 2.